The Ergon blog a little bit to cover a few of the topics regarding the protocol, how to achieve stability, um, why it's superior to Bitcoin's fixed supply model, and why Bitcoin's lack of a fixed production cost and fixed supply keeps it fundamentally unstable. And this is more to show how Bitcoin, even with large amounts of liquidity, can't uh, uh, gain true stability even over time, and how the instability prevents liquidity from growing to begin with. So I'm just going to go over a couple articles that I think apply to this topic, and maybe a few things outside of that topic as well. Um, so if you were interested in learning more about the principles behind Aragon, but didn't feel like reading it or would rather listen to someone talking about it, this is probably a good video to watch. Okay, so the title of this one is From Stability to Liquidity. And right here, you can see that there's a circular process that involves um, more mining difficulty increases. So you have more mining and the difficulty increases, and that produces more coins at a higher rate than there was at the lower difficulty. And more coins issued causes the price to go down again. And when the price goes down, there's less incentive to mine the token. So you have less mining and the difficulty decreases. And when you have lower difficulty and less mining, that results in less coins being issued and the price goes back up. And this process just continues over and over again in what we call an oscillation. So an oscillation is basically a a pattern of fluctuation between a average or like an equilibrium point in the middle. And when there's more demand and price goes up, the price goes above equilibrium. Uh, and as the price goes above equilibrium, there's more coins minted, which um, then has the opposite effect of increasing the supply, which brings the price back down. And typically there's an overcorrection that happens. So there's a bunch of mining and price goes down. And so as the supply increases and price goes down, it tends to then go below the equilibrium point, which then makes it less profitable to mine. Actually, you're incurring a loss to mine. So that should it result will result in less coins being mined, and the supply um the the supply velocity basically goes way down, and there's less tokens available, less coins available for the same amount of demand. So it has this perpetual cycle of oscillating between or around the production cost. And the cycle right here just repeats over and over again. And that that allows traders to get arbitrage opportunities. And when the coin is below production cost, they basically buy it up because miners can't obtain coins at the market price. So when demand goes up, the people who bought will have a opportunity to sell the coin for better margins at a lower price than miners could. And the buying of the coin pushes price upwards. So the opposite, of course, happens when the price is above production cost, and people will sell the token because it's essentially overvalued. So that's an overview of how that works. Let's just cover the important parts of this article without getting too deep into it. So what is money? Money is the most fundamental question we set out to when we set out to build a peer-to-peer electronic cash system. Since that's the goal of Ergon, that's our fundamental question. What is that thing that we want to construct? We get it intuitively, since we use it every day. We're familiar with the properties of money, store of value, means of exchange, unit of account, but I would argue that those are secondary. There's a term called liquidity, which is used in many contexts. Is that company liquid? Or, oh no, there's no liquidity on the market. This asset is illiquid. Those are examples of the use of the same word, but we will focus on the asset liquidity and the market liquidity. Common definition says that an asset is liquid when you can easily, cheaply, and securely convert it into cash. It can't be applied to cash itself because that would be circular. Cash, however, is defined as the most liquid asset on the market. The definition of liquidity involves cash, so we have to patch it. Let's define cash as an asset that is the easiest, cheapest, and fastest to exchange for anything. Liquidity captures the ease of trading, and cash is the special asset that is the most liquid of them all. Then when you trade a particular asset for cash, you're free to exchange it for anything else you want. Peer-to-peer cash has to maximize liquidity. That's the answer to the most fundamental question of the undertaking of creating cash. And here there's characteristics of liquidity, which is the time it takes to sell an asset, tightness, which is cost of transaction, depth, abundance of orders on different price levels, breadth, how large a trade will affect the price, how much of a large trade will affect the price, and resilience, how fast an equilibrium is found after the shock. So that is all to say that liquidity is a fundamental requirement to be cash, and the properties of cash like unit of account, store of value, and medium of exchange are all secondary to the concept of liquidity, because liquidity means that you can use it as a medium of exchange and a unit of account, and essentially a store of value, because when you store your value, you want your savings to be in a very liquid asset so that if you needed to exchange it for goods, you can do that very easily. So an illiquid asset is not going to be a good store of value. And that means that liquidity is very important for all of those uh, all of those things that make money. Um, Others make arguments that in a Bitcoinized economy, the volatility would stop. But we do see fiat currencies collapsing in fully hyper fiat economies. there's no reason why there wouldn't be volatility in an all Bitcoin world. Besides, a chicken and egg problem is a showstopper. And the chicken and egg problem for Bitcoin is this idea that because it's fundamentally unstable, it can't become liquid enough to become cash. And because it can't become liquid enough to become cash, it's fundamentally unstable. And you can't you can't break out of this, even no matter how much liquidity Bitcoin's able to get, because it's not able to get enough to be fundamentally stable. So it won't become it won't become cash. And this is the narrative that crypto or Bitcoin has pivoted away from and towards the narrative that Bitcoin is a store of value because it failed to be cash. And even Bitcoin Cash is faster and fast enough for people to use as money and sorry, and cheap enough to use as money for cost of transaction. But it still doesn't become stable. So maybe it's 10 times better at being cash in the sense that you can immediately exchange it for very cheap. But the inelastic supply and the uh, random production cost of the asset keeps it from being stable enough to be money. So I guess what we learned here is that Ergon has a fixed production cost, which means so it's not just elastic in supply that reacts to demand. Um, because there are a lot of things that are there are a lot of things that have elastic supply that react to demand, like real world commodities, but the production cost of those things become cheaper over time, which makes it basically lose its purchasing power um, in the market. So Ergon takes elasticity a step further and has a fixed production cost, which means the cost to generate 1 unit of Ergon is always the same from the beginning of the protocol's life and forever. So this means that it has a fundamentally stable, fair price for the market to discover. And the more people discover Aragon and find out that it has a stable production cost and a fair, stable value, the price stability becomes this self-fulfilling prophecy where you have ultimate stability in an asset that doesn't get cheaper or more expensive to mine over time. So this makes it a perfect replacement for um, like commodity based money, like real world assets that react to demand, or like fiat um, which has like no tangible production cost. It's like it's very politicized how they come up with the supply of money, and over time it tends to inflate at a high enough rate to destroy the properties of a store of value, which can ultimately lead to the collapse of that fiat currency. So the the benefits of liquidity make things good, stores of value, but if it's a bad, if it's a bad store of value in the sense that it loses its purchasing power over time, that can hollow away the legitimacy of the currency, and ultimately, uh, ultimately hurts the liquidity, because once something becomes fundamentally unstable, it starts losing its liquidity. Um, Ergon replaces the arbitrary emission schedule with a market mechanism, making it similar to any regular good in the world. It is like a metal that can be transported anywhere in the world, to paraphrase Satoshi, that can be used as a medium of exchange. It's still secured cryptographically, and by incentives. It's unstoppable and permissionless, but it also is elastic in supply and reacts to the market conditions. It fundamentally has a fair price to be discovered by the market. According to the mathematical model, it should be oscillating around price equilibrium. But this effect should vanish as liquidity grows by the absence of dynamic arbitrage principle. The features inherited from Bitcoin, and certainly as well as stability, make it the perfect asset for the market makers, which involve merchants, that ensures me that it will eventually achieve the status of the most liquid asset in the world, the global peer-to-peer electronic cash. So that's the from stability to liquidity article. Um, I'm skipping these two. Um, this is a good one. Cryptocurrency supporters are often detached from real-world problems. I've encountered people saying that you do not need censorship resistance of blockchain for everyday purchases because they aren't in any way subversive. Therefore, it's okay if cryptocurrencies aren't suitable for those kinds of activities. For the sake of argument, I'll assume that it's not just a way of coping with the shortcomings of the popular peer-to-peer cash implementations like Bitcoin, but we'll treat it as a genuine argument in the long-term debate. There's around 15 million stateless people. They don't have any citizenship, IDs, and there's no institution to issue one. Because of that, they're denied education, healthcare, employment outside of gray market. They can't rent an apartment because they can't have a bank account. They also can't search their luck somewhere else because they can't travel. Did you know that up until 1974, women weren't allowed to have a bank account? Women in Saudi Arabia aren't allowed in this day. They also can't own a passport, so they can't escape the state of affairs. Victims of economic violence very often have their tormentor controlling their bank account. Domestic violence perpetrators often trace their activity by the names associated with the ID for years after they escape. To all those groups, buying a coffee is subversive. Um, Blockchain is fundamentally inclusive. The core proposition of blockchain is permissionlessness. It means that whoever you are, you can use it regardless of being an ethnic minority, being oppressed based on gender, um, sexual minorities, stateless people, religious where people where it's prosecuted, an apostate in a confessional state, a punk protester, a comedian who offended the wrong politician, or an elder. You're welcome here. Well, maybe not in the crypto communities. I've seen them hostile, but certainly to the protocol. There's a problem that unfortunately prevents it all from happening: volatility. I've participated in crypto communities that embraced the humanitarian aspect of blockchain and made it their talking point. After a particularly deep price drop, we were discussing how awful it is, especially to vulnerable people. The community have just done a lot of onboarding in South Africa, promised the people financial freedom, and they have lost the little savings that they had. All of a sudden, someone, incidentally a whale, came out and said, They knew what they were getting into. It struck me as a particularly nasty thing to say. There is an insidious equivocation hidden within the financial freedom promise. On the one hand, you can understand it as the freedom to transact and go about your business. On the other, you can interpret it as freedom from poverty, the ability to afford things. This kind of financial freedom means being rich. Cryptocurrencies are seen as a risky, quick, get rich quick scheme. The common design is indeed of a decentralized pyramid. The early investors get the new people to buy in under a promise of financial gains, and those in turn recruit the people also for financial gains, creating a neat pyramid shape. Don't confuse with a Ponzi scheme. There are many varieties of pyramid schemes. It results with unimaginable gains for the people who got in early, huge losses for those who came later, and a very unpredictable, dangerous environment for those who just wish to use it and not invest. Ergon moves away from the pyramidal structure with the proportional reward system, achieves both permissionlessness and the fundamental purchasing power stability at the cost of the promise of gains. It's a necessary trade-off. It also follows the big block path of scaling, currently having transaction fees in the range of 1/100th of a cent, making sure that everyone is able to use it. We are yet to see if that's enough to have a permanent impact on the well-being of the people who need it the most, but I believe it has what it takes to empower those who can't even buy coffee without being subversive. So the concepts that people knew what they were getting into when the price crashes, that's that's basically a defense against people who were looking for financial freedom and instead got, half of their savings wiped out because the asset is fundamentally unstable. And that means the priority of the asset is for it to go up in value, which is the concept of a speculative asset rather than a store of value. Um, so the financial freedom that crypto offers is one of inclusion, but the instability negates those benefits quite dramatically. And the opportunity of including people into a permissionless store of value and medium of exchange get wiped away. And this means that crypto isn't really used for its intended purpose unless you create a stable coin. And stable coins have their own problems, such as governance, collateralization, oracles, um, depegging, which is when the exchange rate price goes above or below its intended price. And depegging can be dangerous because it can cause the whole system to collapse. So people use Bitcoin and Ethereum as a base asset to power the system that creates stable assets like stable coins. And this is how people overcome the argument that crypto isn't stable enough to be used because it creates stable coins, which can then be used on the platform for a medium of exchange and a store of value. And that really um, can be ultimately dangerous for the project. I mean, sorry, for the protocol, um, because it doesn't have a stable equilibrium. Um, and the stable asset that is built with it is has a lot of flaws and can be fragile at times. So we make a lot of compromise in saying that the stability is achieved in the network um by adding a stable coin. So that's the subversive argument. And I guess the last one I want to cover is uh stable building blocks. So digging deeper into the need of stability, we're going to talk about decentralized finance and how decentralized finance is built with building blocks. And the current options for building blocks are base assets like ETH to make, like we were talking about, stable coins, um, to power transactions and to be used as collateral in DeFi projects. And I'm just going to read through this a little bit and talk about why the instability um, fundamentally breaks DeFi. So decentralized finance, open finance, on-chain finance, whatever you want to call it, comes in many forms. Some have trusted third parties and some don't, depending on the use cases. Some have governance and some don't, but whatever your view of DeFi is, the overwhelming majority of users believe it to involve a variable number of primitives built as protocols that are combined to make newer applications on top. Decentralized exchange aggregators, yield vaults, and borrowing markets are all combinations of to make newer applications on top. Sorry, are all combinations of protocols to meet a certain goal. Actually, because these networks are often seen as public goods, they're designed to meet collective goals as well. Any collective action should have certain tenets, such as a mutualistic goal, rewarding the good and punishing the bad, and last but not least, stability. Stability in a system is what keeps people from jumping ship and causing a cascade, resulting in failure. Historically, we have had times of stability and instability. Modern times have modern issues, one such being hyperinflation. We see countless examples across the world of governments hyperinflating the money to become worthless, and this sets off a chain reaction of events nothing short of catastrophic. This happens because governments have central authority over printing, they benefit from it, and it has no opportunity cost to produce, meaning there's nothing stopping them to produce insane amounts of money without expending anything to create it. This is the ultimate power in modern times, and countless people seek to wield it for both good and bad intentions. Bitcoin's proof of work was a step in the right direction. It added hardness to money like gold, so producing it can't be costless, permissioned, or centralized. This feature of gold has helped it stand against the test of time as a hedge against fiat. The lesson here is simple. People don't want their money stolen. So how do we learn from these lessons and create a stable economic base? The answer is Ergon. Ergon is a permissionless eCash and the spiritual successor of Bitcoin. To fulfill Satoshi Nakamoto's dream of excuse me, of peer-to-peer electronic cash. Ergon does this with very minimal change, simply by adjusting the block reward from flat to proportional. This allows the currency to stabilize as a medium of exchange. Ergon is elastic like the US dollar, but costly like gold or Bitcoin. Because anyone can mine, they can get proportional value in Ergons. This makes generating supply costly, permissionless, and elastic. Nobody has the ability to produce supply arbitrarily. Minting Ergon always requires an equal cost. Therefore, the benefits of gold and Bitcoin are not deflation, but rather costliness to produce. Ergon thus synthesized a new money that takes costliness of Bitcoin and gold and the flexibility of fiat to create a new gold standard in economics and monetary theory. But why stop there? As mentioned at the beginning, a stable base is critical to decentralized finance or any economy, uh, which gives us the ultimate paradox of crypto. DeFi is built on a hyper deflationary base. We are building a stable future of finance on an unstable foundation, and nobody seems to care. The effects of extreme deflation will continue to stunt the growth of the economy through perpetual boom and bust cycles that send us into catastrophic spirals. For example, most collateral for DeFi loans are in deflationary assets, meaning when shit hits the fan, shit really hits the fan in the form of liquidation. Because the value you collateralized your loan with is spiraling out of control, how long can DeFi ignore the base paradox? Will humanity continue the boom and bust cycle, or will it wake up to the powers of a stable base money? Ergon's synthesis of electronic cash can unify a conflicted and contentious world of economics. Denationalization of money is once again an achievable goal for cypherpunks. With Ergon, we can unite the two wings of economics and supply-based boom and bust, and end supply-based boom and bust. It would be a great base layer for uninhibited economic growth and more efficient cycles. So this picture just of a Jenga tower demonstrates that, you know, in certain cases, there's just one fragile component that everything else hinges on. And if that component breaks or is removed, everything built on top of it will collapse or face failure. And you can see these blocks as different DeFi protocols because they're all interconnected and they all have interconnected risks because they're built like Lego pieces to make more complex products with the primitives. And Ergon is a stable base primitive as opposed to Bitcoin or Ethereum. So it can actually help DeFi scale horizontally. So everything can, increase its liquidity and capital and collateral without making the price fundamentally unstable, causing these boom and busts and price crashes. So those are the three that I took out of the Ergon blog. You can check out those or the rest of them at Ergon.moe. And yeah, I think that those topics really help capture the importance of liquidity and stability and the fixed production cost. All of these things help Ergon become actual money, and Bitcoin is contradictory of the concept of what money is. So it fundamentally cannot become money. So Ergon is literally just a slight change in the Bitcoin protocol so that it can actually become money. And I think that the Ergon protocol and the asset will ultimately win out in the race to having a digital cash because of all this. So, like I said, if you want to check it out, Ergon.moe. Probably gonna find a few more like guests this week. Probably some bigger names than we've had already, and hopefully that their communities and their groups will share it so we can sort of grow this channel and get to the point of reach that I'm trying to get to, which is making Aragon like a top 10 crypto asset and getting everyone to see it and understand it better. So I'll end it there. See you later.